Hi, and welcome to today's class on asset classes. So, I want to really take a moment to talk about asset classes for a couple of reasons. Number one is people usually don't think of asset classes as an asset. And I think that part of the problem is that most people don't really understand what an asset is. And if you understand this asset class, I think it makes it much easier to shoot for something when you are accumulating wealth. So what I wanted to talk about today is basically what those asset classes are and how you can actually position yourself to take advantage of um, these assets. All right. When we think of wealth, we really think of rich people. We think of people who have a lot of money, who spend a lot of money, and more importantly, people who throw money around. But we don't really ask the question is how they got there. And usually it goes something like, well, they made a lot of money in their family. They have a business. They have a restaurant. They have a company, or they saved a lot. But we really don't understand a lot of it because, quite frankly, most people don't tell you um, how they make their money. In fact, if they told everybody how they make their money, everybody would do it. So they try to keep that as secret as possible so that not everybody knows it. But I do believe that everybody should at least know and understand how this kind of process works, so that in the event that you do find something, you should be able to accumulate wealth at a much higher rate. So I call this a wealth pyramid, and this is my interpretation of what I think it should end up being. Um, if we take a look at a pyramid, an inverted pyramid, we look at investments being at the top. These are usually where all the money should flow, and at the very bottom, you should have debt. Now, I categorize debt as the smallest portion of the pyramid for two reasons. Number one is the debt that you find aside from your mortgage and from your cars shouldn't be debt that you're going to be using to spend. It should be used for acquiring a new investment, in some cases to leverage it to get yourself in a position where you can find a new opportunity. The second section is expenses, and we're all going to find expenses either in your company or in your life or just your day-to-day basis. But unfortunately, sometimes they do acquire a little bit more. And obviously, at the very top, we have your investments. Your investments are basically your asset classes that you want to think about. So keep this in mind as I kind of run this through a little further. All right, asset class number one is stocks, and stocks have had a very nice run since 1980, and I think the public, for the most part, is enamored in stocks. And one of the reasons why they're enamored is because they get a lot of media attention. In fact, I've never seen an asset class get so much attention since I was born, and a lot of people are in it. So one of the things with stocks is that they provide capital appreciation. One of the great things about this is that if you take a look at the 1980s bull run all the way to 2000, and even up to today in 2013, you find that if you had picked the right index, the right stock, the right fund, the right IPO, you could have made some real serious money. However, with that, there's also a lot of risk that you take, and a lot of financial planners will tell you that if you're younger you are, you should increase your exposure to 70-80% stocks, and you should drop it down as you get older. One of the key aspects of stocks is to share the risk among various investors, meaning that company goes belly up, you're really looking at whatever share that you purchase losing value. So you want to be diversified, and they kind of go ahead and talk about those things. Third thing about stocks that I like, and I think it's very common with people, is that it's very liquid. And one of the reasons why it's very liquid is because there's a huge market for this. I mean, you're looking at technology, you're looking at S&P 500, you're looking at the Dow Jones Industrial. There's multiple ways to invest in stocks. The fourth thing that's very interesting is that there's broad participation from all generations. In fact, out of all the asset classes that I know of, you guys can correct me if I'm wrong, stocks have one of the most participations. And where else do you actually get people to force to buy an asset class at work, either through an IRA, 401k, through a pension, and even at the younger generations, we're already kind of trained that stocks can be a road to riches, i.e. day trading, i.e. swing trading, whatever you want to call it. The other thing that's really great about this is that it has a 15% capital gains tax rate cap. And there's some legislation about this trying to increase this because, quite frankly, I mean, it really promotes people to invest in stocks when you know that you can you only have to pay 15% tax on this, which is really ridiculous if you think about it. But oh well, that's the law. It is volatile, and I say very volatile in the general sense, just because you could make a lot of money in a short period of time and lose it all within the next year. And a couple of years come to mind is in 2008, 2000, and also the crash of '86, and and so on. So you've got a lot of volatility, a lot of downturns in the market. I recommend index investing, and one of the reasons why is because if you're doing individual stocks, it does not make sense to go ahead and do individual stocks, just because the market, for the most part, is heavily rigged against the individual investor. In fact, institutions have more sway and information, and although we would like to believe that the SEC is on our side, really they open one eye and then they close the other one in terms of insider knowledge, and which is technically legal, but they call it AKA research. All right, the second asset class is bonds, and bonds are basically broken up into two main categories. I want three main categories. The first one's muni bonds, municipal bonds, and I used to believe that municipal bonds were these really safe asset class investments, and one of the reasons being is that muni bonds didn't really default. And part of the reason why is because we believe that cities were solvent. But now, in this last recession, we know that certain counties can actually default on the muni bonds. In case in point, Stockton and parts of San Bernardino County can actually default on the muni bonds and can't even pay their obligations. Treasury bonds, as we all know, treasury bonds are both long-term and short-term bonds. They are considered to be safe, and if you look at treasury bonds, both long-term and short-term, they are technically considered to be safe in the respect that the long-term treasury bonds really don't have any downside risk, and this has been challenged recently just because bond prices have skyrocketed, and they're literally paying next to nothing on the interest. I mean, you're looking at about a quarter percent on most on the 30-year treasury, and in some cases you're actually getting negative growth because of the inflationary problem. I used to believe stocks were the biggest ones, but bonds are actually one of the largest asset classes. In fact, bonds really came before stocks, and after bonds, basically we still use them, and governments use them all the time. So one of the great things about bonds is that people get paid first, and that kind of lowers the risk down a little bit. But part of the problem with these bonds is that when everybody's rushing into them, it becomes a very, very overvalued asset, just like it is right now. I recommend just putting in TIPS inflation-adjusted bonds, unless you got some really high, nice yields going on, and people are just fleeing the bond market. Then you might want to rotate back into it. All right, asset class number 3 are called commodities. Commodities come in different shapes and forms, and for the most part, commodities are really futures contracts traded on the COMEX. It is a global. Commodities are global. They're trading 24 hours a day in various exchanges across the globe. Primarily, it was used really to protect farmers in the event that their harvest didn't show up, and they were able to buy a futures contract that guaranteed a specific price. What it has become is a vehicle for highly leveraged speculation contracts for both short and long, and this is some serious money that's being played out here. I think in terms of commodities, it's a huge market. It's indispensable for economic growth, and one of the reasons for that is because without the commodities markets, you really wouldn't have economic growth in many countries. And so anything that's priced in the current currency, like the US dollar, basically owns the market, because you have to go to the currencies just to acquire the commodities to increase growth in your country. Commodities are broken up into various classes: metals, agricultural, precious metals, and livestock. And for the most part, food prices are heavily tied up to these two, specifically agriculture and livestock. For industry, we're talking about metals, and obviously currently precious metals have been taken a beating as of late in terms of alternative forms of currency, but it's still classified under a commodity and it trades like a commodity. For example, silver and gold. Um, Commodities are heavily traded by institutions. You don't really see much individual investors in there. In fact, retail investors don't really touch them unless uh, it's a special case. And one thing I want to mention is that commodities are really intertwined with governments, and one of them is the Congressional Farm Bill that keeps on getting pork barrel every year. Because what it does is that it guarantees a certain price for farmers to grow specific crops. And what ends up happening is that a lot of farmers end up making a lot more money farming specific products than not. All right, and the last one here is real estate. Oh, let's just take the last one. Real estate is great because real estate basically has a couple of classes, and a lot of people believe that primary residence is an asset class, and I actually to put that one as a separate category just because it can be an asset, but most often not a liability. The primary resident really serves two purposes. Number one is to put a roof over your head, and the second reason is to maintain a sense of ownership when in reality it's really not yours. You're stuck with the cost of maintenance and you're not really generating cash flow. It's basically a place to live. So I don't consider that an asset class. However, if you're investing in commercial or single family homes or apartment complexes and they're generating cash flow, then I think it's a little different. A lot of people like to use real estate as a leverage product, either HELOC loans, home equity loans. And what ends up happening is these leverage products end up creating more wealth than not. All right, and the last one is called a small business. Small businesses are great for a couple of reasons. Number one is that in the case of specific technology companies, you can buy them out, sell them for a nice profit. You don't deal with cash flow. You can just get a cash up front. It serves as a niche market for future cash flow, and what it does is that it provides you with alternate forms of income. And I usually call it owning versus renting income because you are not renting the income when you're working for a company, but now you're actually owning it. Okay, well, thanks a lot for listening, and please fill in the comments down there, and we're good to go.